as we talked about on Worldwide Exchange a couple weeks ago, right? You said, what's the word of the day? I said directionless. And I was really committed to that this is a directionless market that we're in because there's too many cross currents. So with respect to today, I don't make anything of today. Like, who knows? It could be because people aren't here. It could be because of lack of volume. It could be because of, like, last hurrah of tax loss selling. What I think is interesting in my portfolio right now is the biggest losers today are the ones where clearly it's tax loss harvesting with a last-ditch effort to get some losses locked in and offset gains. So I don't really make anything of today, but when we think about next week, I mean, there's been a lot of froth and a lot of enthusiasm over the last month. It's been insane. And so if anything, as we go into next week, next year, I would expect the market to take a pause, catch its breath, relax. Like, that may show up in the form of, I don't know, a 1 to 3% retracement. Who knows? But it feels very exhausting to me. When I take off my macroeconomist, front and actually look at what I do, a portfolio manager, when I look at my portfolio, you know what I want to do next week? There's 3 stocks I want to sell. I want to get rid of 3 stocks that have huge capital gains. I don't want to realize those this year, and I'm going to sit on cash because there's nothing I actively want to buy next week. So if that's translating around, it kind of equates to a pause. It doesn't equate to a big sell-off, but if I'm typical of what's out there, who knows, who knows on next week, but it doesn't look too glorious.
All right, to your left, Jason Snipe. Been a while, Jason. Haven't seen you in a while. A lot of things we want to talk to you about. Give us your sense of the action we're seeing today, and does it give us some foreshadowing for 2024, or is today just today?
So I think Jenny highlighted a few points that I think are important. I think one is it's a little bit of a breather, right? The market has done phenomenal since November, so it's really been running. So I think that might be part of it. I think volume, potentially low volumes, is absolutely a point here. But I also think about as I turn to next month and think about what is the overhang or what's the overlay and what to kind of pay attention to. One is, when I think about taxes and I think about some of the names that have been tremendous winners, why would you sell them today and have to deal with the taxes 4 months from now? Why not sell them in January potentially and look at it 16 months from now, which I think is a lot that's probably playing out in the market. But I also look at just broadly, I mean, the Fed is out of the game. It's no longer, higher for longer. It's now talking about cuts. The market is baking in 6 cuts. I don't think that's likely. I think we'll probably look at around 3 cuts next year. Rates are moderating, inflation is moderating. So there's a lot of bullish tailwinds for the market. And I think oftentimes this game is not as easy as it looks. So it's potentially some other things that we're not thinking about that might serve as headwinds going forward. So, but broadly speaking, I'm still constructive on the market, and I think there's going to be opportunity.
It's constructive, but it sounds like you're saying we're not quite out of the woods yet. There are some issues that could come up. We do have a Fed meeting come up in January as well.
So I think the main thing that I'm thinking about is all of the the cash that's in the market, right? So a lot of surplus of fiscal spending that we've seen over this year. Also going into next year, that could potentially be inflationary. That might potentially put the Fed back into the game. And that is concerning for me as we go forward. So we'll see. And also the lag effect of all the policy that's already been put in place. How will that impact the market next year? Will it play a role?
So, Rob, are you concerned about some of these possible issues that could come up next year? And then also want to get your take on the action we're seeing today.
Yeah, I would tell you that equity markets certainly appear overbought right here. When you look at the RSI indicators, they show that the S&P, NASDAQ, Russell 2000 are the most overbought since 2020. And the stretch has lasted longer than it did in 2020. And so from an equity perspective, when you look at 2023, it was an upside surprise to nearly everybody, not because of better earnings, but because of higher multiples. And these higher multiples came from increased liquidity. The NASDAQ expanded its multiple by 40%. You have to ask the question, can this happen again? And the answer that we have is probably not, and that earnings need to play a bigger role. We have seen a big upside surprise in GDP growth, and it's not translated into big upside in earnings growth. And the market can perform well next year, but it's completely dependent on earnings. And the opportunities that we're seeing are really below the surface and outside of some of these names that have driven the market this year. So when you think about going into 24, I really believe that the guys are right. We're going to focus on portfolio sizing, positioning, and names that we own that are still great businesses, but maybe have pulled forward some of that price performance. And we're going to look to the left behinds to play a larger role. And so the opportunity set is meaningfully bigger. And we think fundamentals are going to play a very big role in that.
So Josh, over to you. One other thing I want to mention is that we've seen bond yields on the long end tick up just a bit. Actually, the 30-year top 4% very briefly earlier today. How are you seeing the market action? Concerned at all about bond yields?
Well, I think you want to see longer-term bond yields pick up, quite frankly. You want to see the curve uninvert. If the reason the market is rallying is because people are getting more comfortable with the idea of next year being an expansion, not a recession, that's exactly what longer-term bond yields should be doing. This is 101 stuff. I don't think anyone should really be particularly concerned with that. I think the big picture here is there were plenty of good reasons to be underweight or lukewarm toward equities or concerned about things going wrong in the first half. But once earnings expectations bottomed and started to tick higher, and once we got confirmation that inflation was trending in the right direction, that was it. Like that was really the signal that the main things that you had to be most concerned with in the equity market were fixing themselves. And that's exactly how things played out. And none of that changes just because the calendar flips over from December 31st into January 1st. The difference between managing money in real life versus writing a newsletter, if you're allocating people's capital, then you know if it's based on a long-term financial plan, you can't afford to miss years like this one. And you definitely can't play this game like, oh, maybe we'll avoid a 1% pullback in January. You can't do that. Because what if that 1 to 3% pullback doesn't come? Then what are you doing at that point? Like, you have the responsibility of people's money. So if you're running a virtual hedge fund or some sort of a model where nothing's really at stake, you're not registered, you don't answer to anyone, it's a different game. If you actually answer to people, you have to tell the truth about the likelihood of drawdowns, that they will not necessarily always be rewarded every time you go into January 1st to start a new year long. You have to explain that potential risk, and then you have to grit your teeth and bear it. And I think that that's what the people on our show do. So 1% pullback, sure, whatever. I'll eat it for breakfast.